Hey, can you hear me? Let me know if you can hear me in the chat below. Just getting things set up here before we get started. Okay, give me 1 second. Just doing a sound check. Okay, let's get started. How are you guys doing? I hope everyone's had a good week and it's been a good recovery week for those who are bullish on the market and aren't trying to short the market. So if you're one of those people, if you're a bullish investor who invests for long term, I'm hopeful that you had a good week recovering from last week's bloodbath. The last 2 weeks have been terrible. So yeah, this week was pretty good for us. We're looking at the S&P 500. Let me just put my picture in picture here. Bear with me. So my first time trying to do this. Yeah, this week was pretty good for us. So this week we're going to talk about how the market recovered from last week. Put my picture in picture here. Into some Chargepoint earnings as well as yeah, this week was pretty good for us. So this week we're going to talk about how the market recovered from last week. Put my picture in picture here. Into some Chargepoint earnings as well as yeah, this week was pretty good for us. So this week we're going to talk about how the market recovered. Let me fix that. That's not good. 1 second. Okay. Cool. So let's jump in, and like I said, we're going to talk about Tattoo Chef as well. So let's start with the bull recovery. So last week was awful, as you all know. We had, for me, I lost about $100,000 in the last week, and it turns out that this week has not been too much better, but at least we recovered. I recovered about 18%, and today, not so great. Let's look at the S&P 500 and the Dow Jones. The S&P 500 is doing pretty well for the last 5 days. It's up 2.58%. Not bad at all. Dow Jones is up as well. It's up about 1%. So not awful. We're getting back up there, and I am happy about that. But of course, I love to always have the dips so that I can buy in more. But I'll take a win for this week. So my portfolio is doing all right. I was up around $340,000 in the last month before all the crashes occurred with CCIV. As you may know, I'm investing very heavily in that, and when the market turned on CCIV, my portfolio, because I had so many shares, I had over 3,000 shares at some point, and have gotten it down to around 2,000 at this point. But going from $10 to what's it called, $60 per share, and then back down to 30, and then 25. I believe we're sitting around 25 at this point. So my portfolio goes up and down. It fluctuates very heavily because I'm so concentrated in a few stocks. So I feel these market swings very well, and I want you all to know that this is normal. This is normal in the market. This is what happens in stock market investing. You will go up and you will go down, and you just have to take the good with the bad, and when it goes down, make sure you have some money so that you can buy in some more. So I'm glad that we had some red in the last few weeks, and today we got some relief, we got some recovery this last week. And Kathy Wood has said this week that she actually believes that the dip in the last 2 weeks has been good for the bull run. She believes that if we were to keep going up, we're going to enter bull territory, or what's it called, a bull trap, right? A bull trap wherein it's pretty much a inflated market where we're pretty much in a bubble, and at some point it crashes very sharply and it catches people off guard, and then people have to handle their margin call, because when that happens, when you go down 25%, 50% in a single day or a few days, people have to react very fast, and most times they don't have enough money to react to save their portfolio from margin calls, or to get in and buy more shares of their favorite positions. So Kathy Wood is happy that we had this correction for the last week, and now that we had some relief this week, I feel like that's going to be continue to be well for the market. Everyone's was worried about the bond yields and inflation, and now that the House and the Senate have passed Biden's $1.9 trillion stimulus act, we're going to see what happens. So there will probably be some increased inflation, but I feel like it's going to be fine. This stimulus is about as much as we spent on World War II, and that was good for our economy, right? The war was good for the economy. Wars are good. We spent about a trillion and a half on that war, and I believe it was $1.4 trillion. And now we're spending $1.9 trillion more on helping our economy recover from the pandemic, and helping people get back to work, helping people get back to having a house to live in, and while keeping their house and a roof over their head and having food to eat for them and their kids. So I personally believe that the stimulus is a net good for our economy, or is going to be a net good for our economy. And I believe the inflation fears are overblown as usual. People will always cry wolf way too loudly whenever there are any signs of bad things to come. And like I've said before, if you've watched my videos on inflation, I believe that inflation is a necessary part of our economy, and it's much better than having deflation, right? It's better for our economy to be doing well. Of course, we want to have our booms and our busts, because that's how the economic system should work. We have periods of leveraging, and then at some point, maybe every 10 years, we have a period of deleveraging. And we saw that in 2008, 2000, and the years and many times before that. So it happens. We go up and we go down. So I'm not buying this great reset narrative. I think it's fine. I think we're perfectly fine. The Fed has said over and over again they don't see inflation getting to their target anytime soon. So they don't plan on changing their policy, their mandate that they're going to keep interest rates low, near zero, until around 2023, 2024, when they expect to see inflation reach and exceed 2%, their target, right? Because we haven't had enough inflation in the past, we've been averaging around like 1.5, 1.2. It hasn't been enough. The Fed wants around 2%, and we haven't hit that in a long time. And they are committed to helping us get that 2%, because inflation helps keep our economy moving, right? We want to keep a balance between interest rates and inflation, because if you have interest rates too high, then the cost of borrowing, the cost of investing is higher, which means you get less returns. And the only reason you're going to have interest rates high is if inflation rises too high. But if you have interest rates too low, then there's higher inflation, or well, actually there is. If you have interest rates too low, then people leverage up too much, and you get more inflation eventually, right? So I think there's just a balance to be played, to be put in place, and the Fed is trying to strike that balance, and people have to give them time to make that work. and we'll see what happens. But at this point, we haven't seen anything that shows we're gonna have any real inflation that's gonna be detrimental to our economy. And if we get close to it, the Fed will figure out a way to act on that, and we'll see what happens, right? Peter Lynch always says people spent too much time trying to prepare for corrections, and he doesn't bother with that. He just invests for the long term. Just pick companies that you know, that you understand, that you plan to hold for the long term, that you believe in, right? And just hold. Just buy and hold. Just like Mark Cuban, just like Warren Buffett. And that has shown to be the best strategy over the long term. So I know I'm beating this horse over and over again, but I just want to be very clear that, yeah, I'm down from my highs of February and January, but my portfolio, I started off with $7,000, putting in more money. I'm up over 10x over the last year, over 16x over the last less than 2 years. So yeah, we might be down a little bit, but most people who are buying and holding, not trying to time the markets, not getting caught in corrections, are doing pretty well. So that's it for the market. I'm glad we're having a relief this week, so that so everyone can stop being so afraid and calm down, reset, reassess their portfolio, and see what's going on. MJ says, I'm never much a fan of anything, but I think this time's different. I wonder what that means. If you want to clarify, I hope that you mean that you're a fan of this stream. This is my first stream like this, so I know it might be a little bit choppy, but hang in there with me, guys. And thank you for being here, everyone. So I see all your chats. Let me know what you want me to talk about in the chat in the live stream, and we can keep moving. So again, I'm glad that we're getting some recovery this week, and hopefully it'll last for next week, so that people can just see that, okay, the market went down. Let's recover. Let's come back up, and be happy about it, and just remind ourselves that it takes time for our portfolios to do what we want them to do. It's going to take time to get the growth that we all want, right? Remember, when you invest, you want to invest money that you don't need right now for the next year or 2 years. You want to have an emergency fund, right? So that you can weather the storms. You don't have to take your money out so that you can make rent, so that you can find food to eat. You want to have your money invested for the long term, and that way you can just, whenever these markets go down, you can just laugh. You can just say, okay, you guys do your thing. I'm gonna go shop and I see sale. Okay, you run. I'm gonna go towards that sale. I don't see anything wrong there, right? I get a discount. My portfolio is down 29%. It's a 29% discount. Me, as a poor kid who grew up as a poor kid, going discount shopping, that's always been good to me. So it's gonna continue to be good to me on the market, so long as I'm investing for the long term, following my strategy. Yes, I am holding Lucid long term. I'm probably overextended right now, so I will probably continue to trim, but I do plan to hold it for the long term. Yes, thanks for that question. So let's continue with the script here. We've done the bull recovery. Of course, we lost some today, but let's keep going. Okay, let me take a little break, drink some water. I hope you guys don't hear my swallowing. I apologize for that if you do. Okay, so we have Chargepoint here. One of my top positions is going down. It used to be 33% of my portfolio, but CCIV way overextended. It went up way too fast. I wasn't expecting any of that. And at some point, if I hadn't kept trimming CCIV, it would have kept going up past like 40% of my portfolio. So I had to keep cutting it because I didn't want to just be a portfolio of CCIV. That would have been a little bit too dangerous for my portfolio, even though I'm very aggressive. So Chargepoint is now sitting around about 15% of my portfolio. I would like it to be more, but that's fine for now. I have 6 stocks in my portfolio. Of course, if you want to know what that is in real time, join us over at patreon.boacademy.org. That's where I share my portfolio updates, and as soon as I buy, as soon as I sell, I'll let our patrons know, and we discuss the stock market in real time every day, every day of the market, and we share new ideas, rumors, and our perspectives on investment ideas so that we can all make better decisions together. So if you want to join us in the Discord and support the channel financially, keep us going. Our patrons are our sponsors. They are the ones that keep the channel going. So I appreciate all of you out there, and I will definitely do a video at some point to call you all out and get some shout outs, because you guys all definitely deserve it, because YouTube doesn't pay me enough to do all of this, and our patrons are the ones that keep this going. About 5x of my YouTube income comes from our patrons. So again, if you want to join us over there, there's about 100 of us right now. Collaboration is very important on the stock market. So we've got to end early on deals like SBE, which is Chargepoint. One of our patrons actually showed me that. CCIV, we got in around $12 per share before it went up to $65 in 6 weeks. We got in early on Open Door, IPOE SoFi, which is my most bullish position. I'm going to talk more about that in the future, but I'm forever grateful to our patrons, because they've helped me find many great positions. My top positions have come from that collaboration. So I'm very happy about that, and I hope that you will join us over at patreon.boacademy.org. But now let's move on to Chargepoint after that little plug. And I'm looking the live chats. Keep your comments coming. Let's do Chargepoint, and I'll read some more in there. And let me check the Discord just to make sure. And let's go. Let's do Chargepoint. So as you know, I love Chargepoint. I actually went on a walk with my little sister earlier today in our little township here in the subs, and I've been here for quite some time now, since I was a kid, and I've been here just recently this year, since I came back from San Francisco. So I've been living here for the last year, but I just went out this afternoon, beautiful day, and in our town center there's a Chargepoint charger out there now, which is a great sight to see. So I took a picture of it, put on my Instagram, link in wdeno on Instagram.com. So if you want to follow me there, go ahead. But I am very passionate about Chargepoint. If you haven't seen my previous videos, I talk about it in great detail as to why I'm so bullish on this company. And if I could only pick, I don't know, 3 companies, it would be one of those 3 companies. And that's just, if I had to choose. I currently have 6 or 7 companies in my portfolio, my growth portfolio, and it's definitely, I believe, top 3 or top 4. But if I had to cut, I would make sure I kept Chargepoint, because this is the ultimate pickaxe for the EV revolution. When Chargepoint wins, the EV market wins, and when the EV market wins, Chargepoint wins. It stands alone from the rest of the market, especially here in the USA. Of course, we got EV Box over in Europe, who has around 200,000 charging stations, so we have some competition there. But as far as the USA goes, Chargepoint is ahead of everyone else, 70% or 7x ahead of the rest of the market, 70% market share. There's blank charging. I have a video planned for comparing the biggest difference between blank charging and Chargepoint and the rest of the market, right? Why Chargepoint stands alone, and it all comes down to the business model. Chargepoint doesn't charge for energy consumption. They charge for their service, their software service, and their installation. So by 2026, they expect half of their revenues to come from subscriptions, SaaS. I've dove into why this is such an important part of this business model. in our previous video. So I'm losing my breath now, so I don't want to talk about this too much more because we have a lot to cover. But if you haven't seen my videos on Chargepoint, go search bullacademy.org. I go into great detail as to why Chargepoint is so special, and how they're going to continue to lead the market. It comes out to the business model. The business model is very important. So go check that out. So this week, Chargepoint, I believe it was yesterday, Chargepoint reported that they had an increase in they beat their projections for earnings. But for some reason, their stock is down today, which is interesting, to say the least. So let's look at Chargepoint. Let's see, what do I have here? Let's do Chargepoint stock. Chargepoint is down 8.5% today. They beat their expectations, and somehow they're down. So let's read their earnings report. Excuse me. Let's read this. Wrong one. There we are. So Chargepoint, the first line here is that Chargepoint had 2021, fiscal year 2021, which ended in January of 2021. So their fiscal year starts or ends in January of the following year. They chose to do that. That's their choice, whatever. So they had revenues of $146 million, and that exceeded their forecast. They beat what they projected. So everyone always says when SPACs come out with their presentations, their announcements for their mergers, people always say, oh yeah, those presentations, they're just marketing. They're just projections. They don't mean anything. Well, Chargepoint projected what they would get, and they beat it. People say people still are upset about that, so I don't know. I listened to their earnings call yesterday. I'm going to probably live stream that tomorrow, just so we can all just pretty much to galvanize people, all of you, to listen to earnings calls, and I can provide commentary on it. But they said great stuff in there. One thing they said in there that amazed me is that their net cash on their balance sheet that they got from this SPAC deal is more than they've ever spent in their 13 years as a company. They have more money on their balance sheet today than they spent in their lifetime to get to this point. 70% market share, 7x ahead of the rest of the market. But they have more money at this point than what they spent to get to this point. So Chargepoint is a very special company, and the reason they're so capital light is because they don't own the real estate. They don't charge for energy consumption. They don't have to strong arm their partners. They just say, hey, let's install your charger station. You figure out how you want to get paid by your customers, and all we care about is that we'll keep the service running. We'll charge you service fees. We'll charge you for maintenance, and we'll charge you for the software. So we have a recurring revenue model. So we don't care how you charge your customers. You can make it free for all we care. And so 60% of the Fortune 50 said, hey, I like that. 60% of Fortune 50, those are the Googles, the LinkedIns, the Verizons of the world. They all say, hey, Chargepoint, we like your model better than everyone else's. 60% of the top companies on the Fortune list, the Fortune 50 list, said, we choose Chargepoint. There's a reason for that. It's because Chargepoint lets their partners be free, and they collect their recurring revenues. By 2026, half their revenues will be from recurring revenues, which is great. So let's read this. So they increased their cash balance to $615 million due to the combination. They started trading on the stock market, on the New York Stock Exchange on on March 1st of 2021, which, as you know, was great. It was a great day for all of us Chargepoint investors, SBE, Switchback Energy investors. So now Chargepoint is a public company, and let's read on a little bit more. Let's do some look into their gross margins. So in the fourth quarter, they had gross margins of 21%, which was up about a 0.6% from the year before, the fourth quarter of the prior year. And their gross margins for the entire year for 2021, fiscal year 2021, was 22%, which is a 10% improvement over the prior year. They increased their gross margins from 12.5% a year prior, and now this year it was 22.5%. That's very good. I'm trying to find, I'm just looking into this very closely because I'm trying to find what's wrong here. Why did they go down so far? They had a net loss of $90.7 million, and compared to, so I guess this is it. So they had a net loss of $90.7 million in the fourth quarter compared to $33.8 million the year prior, the fourth quarter of the year prior. And this was primarily due to a change in the fair value of the company's redeemable convertible preferred stock warrant liability. So some fancy finance stuff here. Talking about not their common stocks, but their preferred stock, which is stuff that's reserved for people with a lot more money, and they get more privileges than common stockholders, but they get less returns. So there's some stuff there. Yeah, so their fourth quarter net loss was increased by $1.1 million for over the year prior. Yeah, so they lost a lot more money in 2020. I wonder why, but all they're saying here is about this, the change in the fair value of their redeemable convertible preferred stocks warrant liability. So to be honest, I don't quite know what this part means, but what I do know is that it's not good, and it has to do with the preferred stocks. I don't invest in warrants, so I haven't had time to look at this, but I certainly will and try to figure out why people are so upset about this part right here, because that's all I really see in this report that is causing all of this reversal. It's down 8.5% today. So this must be the smart money people, the institutional investors reacted to this. So, okay. Like I said, I will take a look into this preferred stock warrant liability issue and figure out why that is such a big deal, 9% reversal deal. So shares outstanding, they have 277.8 million shares outstanding, and that means that their current market cap is 2.7 times 27, let's say 28. What's that, $7 billion? Okay. Not bad. So I believe that this is mostly good. There's this one bad part right here that I see. I've read his whole report. I don't see anything else that really is causing a huge issue here. So if you all know what I can't see here, if you have any ideas, comment in the chat box below. I want to know what you all think about this, because I don't know. I don't know what's going on here. SoFi, I guess Hater says SoFi is my second largest position. We should talk about SoFi. I didn't include it in the title. Let me add SoFi to this, because I do want to talk about SoFi. SoFi is my most bullish position, so let me just update that real quick. and we will definitely talk about SoFi tonight because SoFi is special, very special company. But let's finish up on Chargepoint. So yeah, like I said, I don't see why it's down. But Peter Lynch always said again, people always overreact to news, good or bad. So if I was a long-term investor, which I am, I'm talking to you now, I personally would buy the dip. I don't see. I like to buy more into the companies that I am bullish on when they go down for things that I can't quite understand or figure out why people are so upset about it. And even when they're upset, like with Upwork, when Upwork had a restructuring back in 2019 or 2018, um, and that caused their stock to go down the whole year, I bought them in 2019, and that was a quick. They're up like 5x now from there. So people overreact all the time to good news, to bad news, and news in the middle. So I take this as a buying opportunity. I don't see any reason for people to be this upset about a a beat on their forecast. Um, but again, I think it's gonna be a good time to buy for bullish investors. Let's move on. Let me take a quick break because my voice is leaving me. But I still like Chargepoint. Let me just do this real quick. So Chargepoint 7x ahead of their competitors in level 2 charging. They have 4K commercial and fleet customers, 4,000 commercial and fleet customers worldwide. They're growing, including 62% of the Fortune 50. They've been in business for 13 years, which is, I believe, 3 more years than EV Box in Europe, right? EV Box has more charging stations, but Chargepoint has been at this for for 3 years longer, and they have experience. They've been very capital light, and their software offering continues to grow, which is the important part. Look at the software offering. Look at the recurring revenues. That's the important part of Chargepoint's future. And they have 132,000 charging locations in North America and Europe. They have 88 million charges delivered as of February 25th. Every 2 seconds, someone charges using Chargepoint, and they're saving the earth with this big number, which I really can't quantify. Greenhouse gas emissions avoided to date. So I don't know. I don't know how they get that measure. That's the only thing that is. I feel like that's just a marketing thing. I don't know how they're measuring this, but it's a big number if you care for that kind of thing. Which I mean, in the grand scheme of things, I do care that if this is true, that it is high. But I don't know how they're measuring it, so I don't put too much. I don't give it too much credence. But the rest of the numbers here are important. It's very important numbers here. I'm buying Chargepoint. If I have more, I want more money to buy Chargepoint. I had to trim a bit because it was getting way too much. It was becoming way too big in my portfolio at some point back when it was still a SPAC. So I had to trim a little bit. But I do want to buy more going forward. So let's talk about SPACs. And before we do that, let me just add a thing here for IPOE SoFi. Big news from this week, which was I was very happy about it, but we'll get to it. So we are at the state of SPACs. This is trash. Give me 1 second, let me take a little break, and we will get back to the stream. I'm reading your comments in the live chat as I drink some water. Dum dum gum gum. I am from the planet Earth. If you can guess where I'm from, I've said it before. I believe I've said it before. But if you can guess, uh, I'll give you some kudos. I'll give you a shout out on the video. Good luck. It's pretty easy. Yeah, give me 1 minute. I'll be back at 6:40. 6:40. I'll be back. Okay. Thank you all for being here. We have 22 people watching right now. This is going better than I expected. My first like real live stream. I've done live streams before for our giveaways of $200 every month for our patrons or who support the channel, and that those didn't go so well. But I've gotten some new software now to make this all much better and enjoyable for everyone. So I appreciate you all being here. I'm reading your comments in the chat, so keep those coming. I've added CCIV to the list too, so I definitely see your chats and I am reacting. I want to cut it off at CCIV because I will lose my voice at some point, and I don't want to have you all listen to me with a hoarse voice. So I will definitely do more live streams. So thank you for being here. Make sure you subscribe to the channel, hit the notification bell, like this video. Let me know that you all like this, and I'll keep it coming. And of course, join us over at patreon.boacademy.org to support the channel financially. That's how our patrons are our sponsors. That's how this channel keeps going. YouTube doesn't pay enough, so yeah, I appreciate our patrons again, and they are the ones that keep this channel really going. So join us over at patreon.boacademy.org and get into our again news, rumors, and new perspectives, diverse perspectives on businesses. It's not just me, and there's over 100 of us now, and we share our ideas. So whatever I don't know or whatever I don't have experience with, other people do. So we collaborate. But give me 1 minute, and we'll get into some the state of SPACs. Okay, let's talk about some SPACs. So, I'm not sure if you saw my video last night. I get annoyed when people talk down on SPACs because they've been a net good for retail investors. Of course, it's not for everyone. You have to know what you're doing. You have to understand the companies that you're invested in, and that's always the case in any investment. So it's not just SPACs that you have to do your diligence and make sure that you're investing into sound companies and not just picking on hype. Most SPACs, most companies out there, they're not great, right? most companies, remember the 80-20 rule, right? 80% of your results will come from 20% of your effort in anything. So most IPOs don't do that well. Most SPACs don't do that well. Most companies, they're average, they're mediocre, but there are the ones that are special. You have to look for those ones. You have to be patient and find the good companies. You don't just take a bite at everything. Remember, if you're going to invest, I always say practice the bull mentality, because the bull mentality is that we know what we invest in, we understand what we invest in, we believe in what we invest in, and we hold for the long term, because that's how we build wealth in this country. That's how we give ourselves the best chance of success on the stock market. And that's all I do. So I haven't been burnt by any SPACs yet. Even Nikola, which didn't turn out too well, I got out of that pretty well when I found out that Trevor Milton isn't the guy he says he is. I got on top on that, and it's still up. So I think that if you are really diligent and you pick just the very few that show real promise and some real reputation, some real history and progress, you'll do very well in the SPAC field. And the SPAC allows retail investors to get in on the ground floor into young companies at the same price as institutional investors. This is what I covered last night. I don't want to beat this drum again. So if you want to learn more about why the SPAC is helping retail investors and why the big guys on CNBC and Fox News are upset about SPACs, the rise of SPACs, because it's cut into their profit. They're rich. They get allocations in IPOs. So SPACs do well, they get less IPOs. So they get less IPO pops and they get less profits. It just makes sense that it will be upset. You have to always understand the motives behind what people say on TV, say to you. When I say stuff to you, it's because I came from the dirt. I was poor. I want to be rich. I want to see other people be rich. And I know that when we do well, when all of us do well, I will do well. And when I do well, I want to make sure that everyone else does well. So that's why I say what I say about the markets. That's why I always tell the truth. I'm not motivated by greed. Greed doesn't do you well, right? I believe in Ubuntu. I am because we are. The guys on CNBC, they will watch this economy burn down as long as they get to save every penny in taxes, as long as they get all of the IPO pops, and the retail investors don't get anything. So they say what they say because that just makes sense, right? You have to always understand who you're speaking to, who's speaking to you, and understand their motives and their history. So when you hear them talking about SPACs, when Dave Faber on CNBC talks about how SPACs are all scams and you shouldn't buy them, and they all pile in on that, hey, listen to what they're saying. Listen to what the bad is in their words, what they suggest you should watch out for, because they know some stuff. They're smart, so they have some advice to share with you. So take in what they're saying, but don't take it as dogma. I hate dogma. People always say, "Oh, what is Cathie Wood doing? What is Warren Buffett doing? What is Peter Lynch? What is whoever doing? I want to follow them." No, don't follow them. They're not always right. They are not always right. Cathie Wood picking your stock doesn't make you right. Cathie Wood not picking your stock doesn't make you wrong, right? She has her biases and you have yours. You know some stuff that she doesn't know, right? And investor comes down to, what did you know and when did you know it? Cathie Wood doesn't know everything. So by that principle, the principle of being a human and not being omnipresent, she doesn't know everything. And therefore, you can still beat her at some things. So, no, when people talk about, oh, the SPACs are not doing great and all of that, we have numbers. We have numbers. So, right here, we have this index of SPACs. SPACs versus the S&P 500. This index picks their SPACs, but they're picking many SPACs out of the bunch from SPACs that have are recently raised their IPO to SPACs that have already de-SPACed and have been performing from 2017 to 2021. So let's look at this is from March 4th to the 15th. So people recently saying, oh, SPACs are getting a beating. No, they're doing pretty well over the last, what is this, 11 days, 2 weeks now, 2 market weeks. They're beating the S&P 500. So people always try to, again, people overreact to bad news and good news. So as soon as the market goes down, even if the whole market is down, people will say, oh, what's going on with SPACs? Well, the market's down. The entire market's down. So yeah, the SPACs are also down. SPACs are also companies on the market. So when the whole market's down, yeah, you can expect for SPACs to be down. And of course, they have more volatility because there's so many traders. There's so many swing traders in SPACs, and if you have people who are just swinging it, who don't have any conviction, because all they're trying to do is time the market and figure out when they can get in and when they can get out, I don't fault them for that. You can do whatever you do to make your money. Hey, do you, like I always say, I won't fault you for day trading or swing trading. I just know the numbers. You don't have a great chance of succeeding, but if you want to do it, do it. So you have to understand as a long-term investor that there's traders in this market. SPACs are great for swing traders because there's a floor. If you try to swing it and you miss, you still have your $10 to fall back on. You won't lose that. So it's very safe. And another thing on that is that in market downturns, for SPACs are great in market downturns. Last week, when my whole portfolio was going down, my SPACs were never going to go below $10 per share, or plus or minus a few cents. So I had that safety net. So SPACs were great then, right? I was very comfortable letting my money sit because I take lots of risk that I don't want you all to take. I don't think you guys could take the kind of risk that I take. I'm very aggressive, so I take extraordinary risk. But SPACs allow me to do that because they have a floor. If I miss, which you will miss lots of shots. But when I miss on SPACs, I have a floor. $10 per share. I have that floor. I have that net asset value. No matter what happens, I will always have that $10 per share before the de-SPAC. So no, SPACs are not absolutely bad. SPACs are not absolutely good, and they're not, according to the charts, they're doing pretty well. They're doing pretty well over the last 2 weeks. So the state of SPACs, in my opinion, is good. SPACs are fine. And there might be money pouring into it right now, and there might be A-Rod, the baseball player who fumbled his presentation a few weeks ago. He stumbled over his words. Don't invest in celebrities because celebrities are not business people, right? A-Rod might have business acumen, but don't invest in his SPAC just because he's A-Rod, right? Don't invest in a SPAC just because you have your favorite celebrity on there. If you do that, you will get burnt. The S&P 500, what's it called? The SEC, the Securities and Exchange Commission, now came out this week and said, hey, don't invest in SPACs just because they have celebrities. They had to go and put that out there because people were doing that. Be careful. Again, most SPACs, most businesses, most IPOs, they're not good. You have to be very picky as an investor. You have to learn what your investment criteria is. My investment criteria is very simple. Because I know it, and I know who I am, I know what my goals are, I know what I believe in, I always know if a investment opportunity is good for me. And if it's not, I just say, hey, good luck. Bitcoin going to 500 million in 2 years. Good luck to all of you. I will hedge in case I'm wrong, but I'm not gonna try to FOMO into that. If you guys do well, hey, that's great. I'm happy for you. But it's not the only opportunity out there. If I don't get Bitcoin, it's not like I'm gonna stay poor unless I screw something else up. But you don't need to bite at every single thing. So yeah, there are crappy SPACs, just like there are crappy IPOs. And the only difference is that with SPACs, you get a chance to get in on the ground floor, like the IPO institutional investors who get in the night before, and then it pops like Snowflake, and like Airbnb and like all the others, and they're up double, triple, quadruple what the institutional investors paid, and retail investors are the ones who get burnt when it all comes back down. And usually it doesn't come back so far down that the institutional investors lose their money, because it goes up so far, and it's very hard for the stock to revert that far, so they end up winning still, and we don't get a chance as retail investors to get in on that gold mine. IPOs are gold mines for these people. SPACs are our gold mine. When CCIV went up 6.5x in 6 weeks, who won? Retail investors. We got a chance to participate in that. And the institutional investors, they had to buy in as it went up. We watched them buy in and FOMO into the stock, and then it came back down. So, sorry about spitting. I get very passionate about this because I get very annoyed when people just tell half the story with SPACs and IPOs and the market. So yeah, that's my opinion on the state of the SPACs. I see your comments. Let me just read your comments real quick, and we can move on to Tattoo Chef. I haven't talked about Tattoo Chef in a long time, so I'm very happy to get back to Tattoo Chef. Let's see. So we have thoughts on CCIV. Yep, I have added CCIV. I read the 277 million shares in their writing the press release that I was reading on screen. So that's that. And Charlie says TTCF, and then he says bye. Eric is loading up on Jik. People keep asking me to check out Jik. GIK. I've been getting questions about that for a long time. I looked into it, and it wasn't good for me. So I forget what it's about, but I'll look into it again. Eric says it's about to. He said, "I hope you load it up on Jik. It's about to explode." Okay. Like I said, I hope that it explodes for you. But if it's not for me, it's not for me, right? So that's how I play my game. It's all about. Eric says it's all about Lightning E Motors right now. What is that? Is that the bus company? Is that what it was? Yeah, I don't think I like the bus company. I think that's what it was. I like Indie Semiconductor. AMD is good, but I want to invest in the underdog, the guys that are coming up, so that I can grow with them. Right? The goal of investing is to appreciate your wealth. Right? Grow your wealth and then maintain it. AMD, Nvidia, they're good for maintaining right now. They're gonna grow, but if Indie Semiconductor does well, THBR, that's the ticker symbol. If they do well, and you are investing in them for the long term, you get to appreciate. You get a benefit from the appreciation of the value of that asset, right? So that's how I look at all of this when it comes to comparing these companies. So yeah, AMD and Nvidia might be great and might be the market leaders, but India Semiconductor has a chance to play in this market because we have a shortage right now of semiconductors, and the whole world is dependent on China and other countries, mostly China, and they have very unbalanced power. So we could be in trouble if they ever decide that, hey, we don't like you, USA, enough to give you enough semiconductors to compete against us. We're gonna go to our friends over in Russia, help them beef up their EVs and all of their technology that depends on semiconductors, and then come and attack you. Hey, diplomacy, right? That's how that goes. So anyway, let's move on. Thanks for continuing to chat. Let's move on to Tattoo Chef Inc. Okay, Tattoo Chef Inc. reported earnings. Tattoo Chef Inc. As you know, I am bullish in this company. I've had to cut it out of my growth portfolio, but I am holding it in my future tech pioneers because they are really innovating in the plant-based foods market, in the frozen plant-based foods market, for those people who want to eat healthy but don't want to cook their own meals. So Tattoo Chef Inc. reported earnings this week, and they had revenues of, if you don't know Tattoo Chef, I've covered them in many videos since they were FMCI. So if you don't know them, bowlacademy.org, go check out our videos, go watch our videos on that, because I've covered them since they're a SPAC announced, and I'm very bullish in this company, so go check them out. But let's move on to their earnings. So they say that they had revenues of $39.6 million this year, and that's a 48% increase. Hold up, that's for Q4. At a 48% increase from the year prior. Wow. Okay. That's nice. And their branded product revenue was a record $23.9 million in Q4 of 2020. So they continue to do very well and beat their own records. I love to see it because, like I said in our previous videos, Tattoo Chef's future depends on the growth of their branded products, right? And right now, look at this, 24 divided by 40. What is that, like 80% of the revenues are now coming from branded products in Q4? That's very good. That's what you want to see as an investor in Tattoo Chef. I don't know the math there, I haven't done it, but it's a very high percentage. And that's an increase of 172% over the fourth quarter of the prior year. They jumped from $9 million in the Q4 2019 to $24 million. If you're a Tattoo Chef investor, let's look at the graph, because this is very exciting. If you're a Tattoo Chef investor, you should be very happy about this. So Tattoo Chef is up 3% today, and what is this? Yeah, 3%. And let's look at this real quick, just make sure. So they're up 9% this week. So people appreciated these earnings. Yeah, I'm very impressed by these numbers. Yeah, this is good. If you're an investor in Tattoo Chef, you should be happy, and this market has reacted accordingly. They are up 172% in their branded products. The big difference here between branded products and their other products is that they control the entire life cycle of these products. They are vertically integrated. Most of their products, like 98%, 90-some% of their products that are branded are going through their entire supply chain, and that they control. They get to choose what they make. They get to choose how fast they make it. They get to choose their efficiency. They get to cut down their cost, which means increase margins, which means more profits for the company and for shareholders going forward. If they ever choose to issue dividends in the future, hopefully way out in the future, because I don't like dividends right now. I want you to grow your company first. But if you get these margins up, you get these expenses down, you're going to increase net income. And that's what we see here. So the net income increased to $41.5 million in Q4 2020, and that's up from $2.2 million the year prior, and that apparently is because of a one-time tax credit benefit from the change of their corporate structure. So complex financial stuff. That's what happened. They got a tax credit, so it's not going to be this high next time. But just keep in mind that it's because of this tax credit. So let's move on to EBITDA, and this is good. So they're increasing their EBITDA margins, They had EBITDA revenue of adjusted EBITDA revenue of $3.7 million, and that's 9% of the revenues, and that's up from 8% the year prior, which is good. They're growing that. It's not a huge jump, but it's 1%, which in finance is a big amount. And for the year, for 2020 as a whole year, compared to 2019, they have revenues of $148 million. And I believe that's good. I want to know what they projected in their what is it called? Investor presentation. Let's see. Let's look at this. Investor presentation, TTCF investor presentation. Sorry, let me just find this because it's important that we see how they've done compared to what they said they were gonna do. It's loading. It's loading. Here it is. Let's look for their revenues. Sorry, I should have had this before, but I am now very curious about this. They're expecting $222 million this year, but what I want to see what they projected for 2020. They projected $148 million for 2020, and what did they get? They got $148.5 million. Right on the money. So again, people always like to say, oh, SPACs always put out these projections about what they're going to do in the future, and it's not true, and blah, 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 right? We just saw, who was that? Sorry, not CCIV. Let me just go back to my presentation real quick. We just saw Chargepoint hit their projections, and now we're seeing Tattoo Chef do the same. So these SPACs are hitting their marks. And if they can continue to do that, then SPACs will continue to get better names, but these companies will themselves continue to do well and get more credibility. So if they tell you they're going to hit 148 and they hit 148.5, that's great. And so if they tell you they're going to hit $222 million for 2021, then you have more reason to believe them because they hit it this time. So this 2020 revenue is up 75% compared to 2019. That's 75% growth. Let's look at their graph again. So they're growing so fast. They almost doubled in between 2018 and 2019, and they're nearly doubling, 75%. Up from 2019, and they expect to add another $80 million to 2021. So again, if you're an investor in Tattoo Chef Inc., these numbers are great. And they got help from this one-time credit tax benefit, but I don't believe that this was so big that it's going to be a huge impact on their projections for the future. So maybe they got, without this credit, maybe they would have got like $140 million dollars in revenues. That's still getting close to their projection, even if it was 146, right? So they're not too far off, even with this tax credit. So I like what I see here from Tattoo Chef, and 75% growth from the year prior. Let's keep reading. Their net income was $45.4 million compared to $5.6 million the year before. And again, the tax benefit noted before had an impact on their revenues. And yes, right here, let's see it. Tax asset benefit of, so it has to do with their deferring their tax assets. So of $40 million. So, and I believe they would have included that amount in their projections. So maybe they did hit their mark, their projection on the mark completely. So I believe them. If they said they're going to hit 220 or 222 this year, I have reason to believe them now. If they're growing this fast and they're hitting their marks. And they say that the Tattoo Chef branded product revenue was a record $84.6 million in 2020, over 363% over 2019. 363% over 2019 in their branded product. Remember, I said that this is the key here. Branded product revenues. These are the products that they have full control over. So you want to see this continue to grow. Hopefully they can get us to, I don't know, hopefully they can get it to 90% of their revenues. Even 100%. I would love to see 100%. Just get rid of the partnerships. I want to see them just do branded products. Maybe keep Trader Joe's and Sam's Clubs, but 95% will be great. That's what I want to see. So let's move on. They had their net income was $45 million compared to $5.6 million the year prior, and their adjusted EBITDA for the year was $9.6 million, or 6% of the revenues, which was down, which was up in absolute value from $6.9 million a year prior, but it was down in percentage wise, 8% from the year prior. So they decreased their revenues for the whole year, their percentage of the revenues and their EBITDA for the whole year by 2%, which isn't great. So that means that this year they had less profits, less EBITDA profits in their revenues by percentage, of course. So not great, but also not that bad. So I think the market reacted pretty well to that. It's up 9% for the last 5 days and up 3% for the last day. So I think the market appreciated this report, as I do. If you're a long-term investor in this company, I believe that you should be happy about this. So let's move on. If you have thoughts on Tattoo Chef, let us know. Let me know in the comments. The comments in the live chat. So let's keep going. We've done Tattoo Chef. We have 2 more points and we can call it a night. This has been going on for quite some time now. If you're enjoying the video, remember to like the video below. I will only do this if I know you all enjoy it. And so far it seems like you guys are enjoying it. So thanks for being here, and I will keep this coming. So remember to like the video below, subscribe to the channel, hit the notification bell, and comment, of course, your thoughts below in the live chat. And join us over at patreon.bullacademy.org to support the channel. Help us continue to keep this channel running. bullacademy.org, producing breakdowns of investing topics and companies, and just my thoughts on the markets. Trying to make sure I always share with you all the full truth, right? And without all the CNBC bias behind it. So join us in Discord. That's where we discuss the stock markets in real time every day, every stock market day, and yeah, just share our thoughts and ideas, news and rumors, getting in early on new deals like IPOE SPE and CCIV and so many more. So I hope to see you over in patreon.bullacademy.org. So let's move on. Let's do SoFi. Let's do IPOE. IPOE is now my biggest position by far. I'm incredibly bullish in this company, and I believe there's good reason for that. I like SoFi a great deal because I want to own a bank. I want to own a bank, and SoFi is one of the best banks out there. I joined their membership, I think, in 2019, and I refinanced my student loan using their product, and I got great rates. And then they launched their money, and I used their money, their savings and checking account, and now I have their credit card, which I like. They're trying to innovate on credit cards and make it easier for people to pay down their credit card debt and not get trapped like the rest of the credit card companies make them. And the reason they want to do that is because if people have incentives to pay off their debts, they will pay off their debts and they'll be able to afford better debt, right? If you have credit card debt, which is bad debt, you can't afford to get the good debt, the mortgages, right? The business loans, the personal loans. So SoFi wants to help you cancel or pay off your credit card debts so that they can sell you a mortgage. They can say, hey, we see that you're doing very well on your credit card debt. Here is a better interest rate. We're gonna knock off 1% because you haven't missed a payment for like 12 periods. So because you're doing so well, we're gonna help you out, pay it off faster, and we're gonna offer you a mortgage. Do you want to buy a house? You're doing so well. You're moving forward in your life. Here is a mortgage. Here's great rates, and go buy your house. You've earned it. And do you need a personal loan to do whatever you want to do in your life? Here it is, because we see that you're trustworthy. And do you need a place to save your money? Here it is. And because we have in this whole ecosystem, we can track your progress, and we can offer you more services in the future, right? We know how much money you make. We know how much money you spend. We know how good you are at credit, paying down your credit and spending your credit, right? So we're gonna give you all of this so that we can get more information about you and then give you more. So SoFi's marketing costs, their customer acquisition costs, are way low because they have you in this huge ecosystem that they can just say, hey, I see you are using the app more. Here's a new service. And it's free. That's free marketing. So they have lower expenses, right? You want to find companies that can centralize and be vertically integrated so that they don't have to go out and pay Facebook and Google all their money to do search and social media marketing for them, right? Advertising. They can save all that money, build better products for their customers, give them incentives, and get more money from their customers, and keep them in their ecosystem for a longer time, and build larger lifetime customer value. So SoFi does all of this very well. That's why they're one of the top, most innovative companies on CNBC's list. So all of that, and then they want to be a bank. They received their preliminary approval from the FTC to become a bank, which is great. And because they have that, they can build a bank from scratch. But this week we learned that their CEO said, hey, we could build a bank from scratch, but we don't want to do all that. We're going to just buy a bank. So they bought a bank. Let's just briefly read the news. SoFi buys bank. I'm going to do a video on this later, so I just want to just quickly get through this and let you know what the bank was. They bought a bank. So it says here, SoFi, sorry, let me just put this on picture-in-picture. It says here on TechCrunch that SoFi, more formerly known as Social Finance, announced today, and this again is the ticker for this is IPOE. If you're actually no, now it's did they go public yet? Yes, I believe so, right? Sorry, sometimes I have too many tickers in my head, so I forget sometimes the state of these companies. So yes, there's still IPOE. The ticker is still IPOE. If you want to invest in SoFi, it's IPOE by Chamath Palihapitiya and Social Capital. So if you're interested in that, go check it out. And I have a video on it before, so you should go watch that if you want to learn more. But it says that SoFi announced today that it has agreed to acquire Golden Pacific Bank, Bank Corp, for about $22.3 million. And according to TechCrunch, the dollar amount is staggering. And they say that what's notable about the acquisition is that it's given SoFi a quick route to getting a national bank charter. SoFi, a digital personal finance company, got a preliminary approval from the FTC and in October. And by acquiring Golden Pacific, the company gets a fast track into the process. Once that transaction closes later this year, Golden Pacific Bank will become a subsidiary of SoFi. And just this last point, because I'm losing my voice, we gotta cut this pretty soon. So Let me just get through this last point, and we can talk about CCIV real quick, and we'll call it a night. But this last point says there's a lot more here, but I'll do a separate video on that this weekend, hopefully. So this last paragraph says a national bank charter gives SoFi the ability to accept deposits, make loans that use SoFi's member deposits, as opposed to funding its loans offerings as a non-bank by contracting external underwriters at a premium. So what is it saying is that, I know I read that, I can barely talk right now, so I know I read that a little choppy, but the point here is that because SoFi is not a real bank right now, they just use partners. They're just a tech company that uses partners to offer their banking services. Because they have to do all of that, their services, their products are more expensive than they have to be. So the banks have a leg up on them because they don't have a middleman. The bank, if the bank wants to give you a loan, they just give you a loan. But if SoFi wants to give you a loan, they have to call a bank up and say, hey, one of their partners will say, hey, we have this client here who wants to get a mortgage or a personal loan. Can you give them a loan for us? And so they say, okay. The bank says, okay, cool. But we're going to charge you 1% or 2% on that. So then they have to pass that fee through to their customer or absorb it themselves, right? So now, if SoFi could be a bank on their own, they're going to cut that middleman. They're going to cut those banks out of the picture. And they keep all the money themselves. They give their customers better rates, and everyone's happy. So being a bank, there's bigger reasons. There's even more important reasons for why they should be a bank and why it's going to be great for them. But that's the gist, and I'm very excited. I'm very excited about this. So I've said enough for this right now. We'll talk about this more, but because there's a lot to cover here, it's very important. But I have to cover CCIV real quick, and then we can call it a night. So if you're interested in SoFi IPOE, let me know in the comments, and I'll definitely cover them more. Okay, so we have this last document by demand request from one of the comments, and this was from Black Bleach. So I hope you're still there, Black Bleach. We've been going for 80 minutes now, so I know it's been long, and if you're not there, hopefully you watch this later, but I talked about CCIV, so let's do it. So CCIV had a test drive this week with their CEO, Peter Rawlinson, the guy who has the audible voice, magnificent voice. Can't be on the study. Let's just watch Peter Rawlinson, CCIV, Lucid Motors test drive. Let's just watch this real quick.
Out on the road. First drive in this car, super exciting. We're going to head up to Skyline and test the car through the mountains. We've got some really twisty sections, which will be the perfect proving ground for the vehicle dynamics. I'm really looking forward to this.
He's driving the car on the road. People keep saying, I mean, I've said it too. I've said they have to produce cars, they have to sell cars. It's not easy. Most car companies fail. So if they can produce the cars and they can sell it and offset their heavy cost of production and business, they will succeed. And if they can survive for the next 4 years, 3 years, they get out of the woods. They get to become a real company, right? And continue to build profit margins. So they have to get through this stage first, and it's promising to see that they are able to actually build a car that they can test. Right now, they're not Nikola. This is not a car rolling down a hill. This is Peter Rawlinson, a guy from Tesla, very credible, driving a car on the road with GoPros in front of him to help him present what he's doing, and he's even criticizing his own car. and they publish this on YouTube. So they're being very honest, right? He's taking a test drive here to see how the car's performing and explain to viewers what he believes is good about the car and what he believes can be improved during this testing stage as they ramp up to build more cars. So they even got approval to start phase 2 of their production facility in, what was this? What is the place? I forget it, but I'll cover that in a video soon. But they are moving forward. They're a real company, as far as I can tell. And this is not another Nikola. They have history here. So I am very appreciative of them doing this test drive in the public and letting us all know what's going on. Keeping investors updated on this stuff. This is what we want to see. So let's hear what he's saying.
Still in heavy traffic, impossible to unleash the capability of the car here. But it's nice and taut, experiencing a whole range of different surfaces. Very pleased with the whole ride quality and the suppleness of the suspension. That's great. We've tested that thoroughly. I've tested that before. And this is every bit as good as...
There was a point where he was criticizing a part of this car that he's testing, but we missed it. But if you want to watch it, there's a video. The video is on YouTube. Just go to Lucid Motors on YouTube, and you can find the whole video and watch it yourself. But let's keep watching.
The prototypes. The road is about to get more interesting. I'm getting great steering feedback here as we head up through the hills. The turn-in response is phenomenal. The body composure. This is a complete machine. Nice lot of feedback at higher speed as well. I'm liking it a lot.
Look at that. It's going uphill. This is not going downhill like Nikola. It's going uphill. So I'm loving it. I'm loving it.
It's unlike any other car I've ever driven. It really is. It's taking it to a whole nother level.
Thank you.
Nice car.
Well, it's pre-production now.
They
Almost there. Yeah. It's one of our. It's just come out of the factory last week from Arizona.
Oh God.
Thank you so much. I hope you like it. It's my baby. It's got 1,000 horsepower.
Got 1,000 horsepower.
500 mile range. 500 mile range.
500 miles.
This is the first time we've ever driven one without camouflage on the road. Are you serious? Serious, yeah. First time ever, yeah.
Oh, they've been driving.
So you've got the scoop of...
They've been driving a car on the road before. That's what he's saying here, that they've been driving on the road before, but they've always had camouflage on it so that people can't tell what they're doing. So now they're showing it out for the first time.
All scoops.
Wonderful, wonderful. I like that. I'm very happy about that. So I'm glad that they released that. I don't know if that last part was authentic. I don't know if they set that up, but whatever. Doesn't matter. As long as the car is driving and is operating, and hopefully soon it can actually once they have production quality video, what's it called? Vehicles, they can actually get car journalists, to go in there and actually test it themselves, so that the public can get a unbiased review of the cars. So hopefully that comes soon. But for now, I'm happy with this test drive by the CEO, Peter Rawlinson. So we have come to the end of this live stream, and I want to say again, I appreciate you all for being here. It's been great doing this. This went a lot better than I expected. So thank you again for being here. And if you enjoyed it, like the video below. Like the video below. I would greatly appreciate that, so I can know that you all enjoyed it and that you want to see more of it. And if you want to help me continue to put this channel together, keep it going, and grow this to hopefully one day compete with the likes of CNBC, because that's my goal of this channel. I want to get so big that we can have a channel that is dedicated to the retail investor, and without all the bias of the rich guys, right? And I can only do that with the help of financial help from our patrons at patreon.boacademy.org. So if you want to help us get there, I'm serious about this. I want to build that network for retail investors. So join us over at patreon.boacademy.org, we're just getting started. You're at the ground floor of bullacademy.org. And if you ever need a reminder as to what we're doing here and what our mentality is, how we invest, go to bullmentality.com. Go to bullmindset.com, and you'll never forget the bull mentality. And the bull mentality, just last time, is that we know what we invest in. We understand what we invest in. We believe what we invest in, and we hold for the long term, because that's how we build wealth in this country. That's how we give ourselves the best chance of success on the stock market. So I hope that you have had a good last 2 weeks. I hope that you bought the dip. I hope that you've recovered some of those losses from the last 2 weeks, and I hope that you're holding for the long term and not trying to time the market. And if you are, hey, I hope you're winning. If you're a swing trader, more love to you. I don't swing trade. I don't encourage swing trading, but if you are a swing trader, I hope you win. Good luck. So I really appreciate you all being here. Again, join us over at patreon.bullacademy.org. That's where I share my early research, and that's where we discuss the stock market, where we're all investing in, where I share my investments in real time. As soon as I make a buy or a sell, it's in my portfolio update for our patrons to know what I'm doing and how I'm thinking about my investments. And they share their investments too, and they let us know. We share our wins, we share our losses, so we can encourage one another to continue to hold for the long term. So it's a community, and I plan to continue to grow this community for the long term. So I would love to have you over there and help us all find new deals together, getting early on deals like CCIV, SBE, IPOE, and so many others early before everyone else gets in, before the hype and the FOMO that you don't want to buy on, because you always get burnt when that hype and FOMO dies out, as we saw with CCIV. So we got in early at $12 per share, and we watched it go up to $65 per share over 6 weeks, and then it came back down, and now we're sitting around 25. So we're still doing well, and that's the value of the community. So I hope to see you all over there, and that's it for now. So thank you again for being here. I'm Lincoln with bullacademy.org. Thank you again, and have a great night.